October 29, Black Tuesday, the stock market lost 12% of its value in a single day. Within 3 years, it had lost 90%. 13 million Americans were unemployed. 9,000 banks failed. Farmers watched crops rot in fields because the prices were so low it cost more to harvest them than they were worth. Families stood in bread lines stretching around city blocks. The American dream did not just pause. It collapsed, and for over a decade it did not come back. But here is what the history books never fully tell you. The Great Depression was not an accident. It was the predictable consequence of specific decisions made by specific people inside a financial system that rewarded recklessness and punished ordinary Americans for the recklessness of others. And while millions suffered, some people made fortunes. This is that story. To understand 1929, you need to understand the 1920s. The Roaring Twenties were exactly what the name suggests. America was booming. The economy was growing. New technologies, automobiles, radios, household appliances were transforming daily life. And the stock market was on fire. Between 1920 and 1929, the Dow Jones Industrial Average increased by nearly 500%. 500% in 9 years. And Americans, for the first time in history, poured into the stock market in massive numbers, not just wealthy investors. Ordinary people, factory workers, shopkeepers, farmers. Everyone wanted a piece, and Wall Street was very happy to help them get it. Through a system called buying on margin. Here is how it worked. You want to buy $1,000 worth of stock, but you only have $100. No problem. The broker lends you $900. You put up just 10%. If the stock goes up, great. You profit and pay back the loan. If the stock goes down just 10%, you have lost your entire investment, and you still owe the broker $900. The entire American stock market of the late 1920s was built on this leverage. People borrowing enormous sums to bet on stocks that were already overvalued. A house of cards built on debt, and everyone could see it, except the people who were making money from it. When the market started falling in October 1929, the margin calls began. Brokers demanded their loans back. Investors who had borrowed heavily to buy stocks now had to sell at any price to cover their debts, which pushed prices lower, which triggered more margin calls, which forced more selling, which pushed prices lower still. A cascade, a waterfall, a financial avalanche that fed itself. Within days, the market was in free fall, and the banking system, which had lent enormous sums to stock speculators, started cracking. Banks that had invested deposits in the stock market were now holding assets that were worth a fraction of what they had paid. When depositors heard their banks were in trouble, they rushed to withdraw their savings, which made the bank's problems worse, which caused more bank runs. 9,000 banks failed between 1929 and 1933. And every failed bank meant depositors who lost everything. There was no FDIC in 1929. No deposit insurance, no government guarantee. If your bank failed, your savings were gone. Period. Now here is the part of the Great Depression story that almost no one tells. While ordinary Americans were standing in bread lines, some people were getting very rich. The investors who had seen it coming, or who simply had the resources to survive and take advantage, were buying stocks at pennies on the dollar. Real estate at fractions of its former value. Entire businesses for almost nothing. Joseph Kennedy, father of President John F. Kennedy, reportedly pulled his money out of the stock market weeks before the crash after his shoeshine boys started giving him stock tips. His reasoning: when shoeshine boys are giving stock tips, the market has gone too far. He survived the crash with his fortune intact and spent the Depression years buying distressed assets cheaply. Andrew Mellon, Treasury Secretary during the crash, became famous for advising Hoover to let the Depression run its course. Liquidate labor, liquidate stocks, liquidate the farmers, liquidate real estate. His reasoning that the Depression would purge the rottenness from the system. What he did not mention was that people like him with substantial cash holdings and real assets benefited enormously from that liquidation. They could buy everything The desperate were forced to sell. The Depression lasted a decade, not because nothing could be done, but because the wrong things were done first. The Hoover administration's initial response was to do almost nothing. To trust the market to correct itself. The Federal Reserve, created specifically to prevent financial panics, raised interest rates in 1931. During a depression, making borrowing more expensive, tightening credit, at exactly the moment when the economy needed the opposite. Economists still debate why. Some argue it was ideological, a belief that the market needed to purge its excesses without interference. Some argue it was structural, the Fed protecting the gold standard at the expense of the economy. Some argue it was simply a catastrophic miscalculation. Whatever the reason, the result was that the Depression deepened when it might have been contained. It took Franklin Roosevelt's New Deal, massive government intervention, public employment programs, banking reform, deposit insurance, to begin stabilizing the economy. And it took World War II and the enormous government spending it required to finally end the Depression completely. The Great Depression was not an act of God. It was the consequence of a financial system with no guardrails, where leverage was unlimited. Speculation was rewarded, and ordinary people had no protection when it all fell apart. The reforms that followed Glass-Steagall, the SEC, the FDIC were designed to make sure it never happened again. And then 70 years later, those reforms were quietly dismantled. And in 2008, it happened again. Different details, same structure. Understanding the Great Depression is not history for its own sake. It is the instruction manual for understanding every financial crisis that came after. Subscribe to Finance Origins. Follow the money because the money never lies.